guys, welcome back to the channel. In this episode, I will be discussing about put option contract. In the previous episode, we have discussed about call option and how call option works. If you haven't watched that video, I would strongly recommend please watch that video and then resume this. Let me start this topic with definition of put option contract. Put option is a contract which gives the right but not obligation to sell the underlying asset at a predefined specified price on a specific date. Is it clear? What was the definition of call option was? Call option is a contract which gives the right but not obligation to buy the underlying asset at a specific price on a specific date. So what is the difference between call option and put option? So in the put option, we saw the buyer gets right to sell the underlying asset or product. But in the call option, the buyer of contract gets the right to sell the underlying asset, to sell the product. Is it clear till here? So let's move ahead with topic how put option works. Already I said options behaves like insurance policy. We might all know about insurance policy. Let me tell you about auto insurance company, right? How auto insurance company works. There are three parts. One is we pay something as a premium to the auto insurance company, and second part is if our car gets damaged, then insurance company will provide compensation, and third step is if no damage, then our initial premium is not refundable. The premium will be taken by insurance company, that is not refundable. That's how insurance policy works. And options contract also works same way. So guys, let's take one example in order to understand how put option contract works. There is a farmer in the village who cultivates onion. Onion current market price is 100 rupees per kg. The farmer thinks the price of onion will go down within 2 months. So that's why he thought to purchase put option contract. Why he thought so? Because we all know by purchasing put option contract, he will get compensation if something happens. That means if the onion price will go down, then definitely the seller of the contract will give compensations to the option contract buyer. Is it clear? So let me go ahead with this topic. So the farmer bought the put option contract. By purchasing put option contract, he gets right to sell the contract today current market price. That is strike price. Now 100 rupees, right? If the onion price will go down, he could sell onion at 100 rupees per kilogram. After 2 months, the onion price will drop, let's say at 50 rupees per kilogram. But still he could sell the onion at 100 rupees. We saw in the definition, there is no obligation for put option buyer. What is meant by that? That means if the onion price will go up, then the buyer could cancel the contract. That means if the price of onion will go up, then definitely the farmer will cancel the deal and he sell their onion to another person. Because after 2 months market price, let's say around 150. So why would you say to the seller at 100 rupees? He could sell the onion to another person at current market price 150. So he will cancel the deal. That means there is no obligation for put option buyer. So this is a great opportunity for option buyer. If something happens, the price will go down, seller will compensate. If something not happens, price will go up, then definitely he will cancel the deal and sell their product to other person. It's a good opportunity for option buyer. So will he get this opportunity for free? Definitely not. He has to pay some amount as a premium to the option seller to purchase this contract. This is called premium, right? Let's say 4 rupees per kilogram as a premium he has to pay to the option seller in order to get this right. What is the right? Already I said. So premium is the maximum profit of option seller. That means the price of onion wouldn't go down. After 2 months, the onion price at 100 or 150, 110, 200, 300, more than strike price. At that scenario, the seller wouldn't pay anything to the contract buyer. They will keep, that means the seller will keep the premium which had been paid by the buyer at initial stage. So that's how put option works. I hope you understood the concept of put option. So guys, let's understand practically. Over there you can see a current price of Nifty is around 18,000, right? And you think the price of Nifty will go down by weekly expiry. Weekly expiry is around 10 January, you can see, and time 7 and to 3 p.m. And you think by expiry, the price of Nifty will go down 17,900, right? That's why you think to purchase put contract. Why do you think so? Because by buying put option contract, you will get the right to sell this contract at strike price, and strike price is around 18,000. Like this, 18,000 Nifty put contract. If you buy this put contract, you can sell Nifty at this price, 18,000. If the price will drop, still you could sell at this strike price, because seller will compensate you. The price of the contract is 100. This is called premium, and the buyer has to pay to the seller. Whenever you go to the purchase, this is the value of the premium, and 50 quantity, this is lot size. Okay, that means it's a fixed minimum quantity you have to buy. Okay, and you can multiply like this 150. This is for Nifty. We will know all this later, don't worry about that. But right now just understand how put option works, right? Let's say on the expiry date the close price of Nifty is 17,950. That's mean 50 point below from strike price. The seller will compensate that 50 point to the buyer, but the buyer of the contract already paid 100 rupees to purchase the contract. This is not refundable. That is the value of contract which gave buyer to the seller. So if Nifty closed 17,950, then the buyer of the contract PNL would be around minus 100. That is premium gave to the seller at initial stage. Now he is taking 50 compensation from buyer, so plus 50. Still he is in 50.8. For the put option buyer, strike price minus premium. That's means 18,000 is the strike price minus premium around 100. Break even would be 17,900. That's mean on the expiry date, Nifty has to close below the break even point. That is 17,900. Let's say Nifty close around 17,800. Then what would be PNL for option buyer? Let's calculate. On the initial stage to purchase the put contract, the buyer had to pay premium to the seller, that is 100. So initially minus 100. Okay. And now close price is around 17,800. That means 200 point down from 18,000 strike price. That means the buyer will get compensation 200 from seller. So that means 100 rupees profit for option buyer. That's how put option works. I think you have understood how put option works. If you don't, I would strongly recommend please watch this episode again, and if you have any queries then feel free to ask on comment sections. I will be there for you. So that's how buyer can make profit by purchasing put contract. But what about the profit of seller? The maximum profit of seller is premium. If Nifty price wouldn't go down, then the seller will take this premium. It's not refundable, right? So the maximum profit of option seller is 100, and the probability of winning of seller is around 70%, and the winning probability of put option buyer is around 30%. Why am I saying that? Because on the expiry date, what may happen? The Nifty price will at the same level, what is the current level is, or the price will go down or price will go up. The buyer of the put option contract will make money only one scenario, if market will go down. But the seller can make money if the Nifty price wouldn't go anywhere, what is the current market price is, and on the expiry price is the same, 18,000. On this scenario, seller will make money. And the third scenario, if the market goes up, seller will make money because they don't have to compensate to the buyer. So buying put option, you can make unlimited profit, but there is only 30% profit probability. But for the seller, there is a 70% profit probability and limited profit, that is premium. So that's how put option works. Already I discussed in this episode. I hope you understood. If you don't, then I would strongly recommend please watch this episode again. That will definitely help you. If you have any questions regarding this, feel free to ask on comment sections. I will be there. Thank you. Thanks for watching. Bye bye.